A personal loan can help solve a financial problem or create a much bigger one. The difference comes down to one calculation most people never make before they borrow. Many consumers focus almost entirely on the monthly payment. They ask whether they can afford an extra $200 per month. They compare interest rates. They review loan terms. While those details matter, they often overlook the bigger financial picture. Before applying for any personal loan, you must first understand your existing debt obligations. This process begins by identifying every monthly payment you currently make. Include your mortgage or rent, car payments, credit card minimum payments, student loans, personal loans, and any other recurring debt obligations. Once these numbers are listed, add them together to determine your total monthly debt obligations. Another important lesson is understanding that lenders evaluate risk differently than borrowers. Borrowers often focus on what they can manage today. Lenders focus on whether additional debt creates future repayment risk. Another major issue is that many people underestimate their actual debt burden. Small monthly payments spread across multiple accounts may not feel overwhelming individually, but collectively they can consume a large percentage of income. Another critical lesson is understanding that debt exists to solve problems, not create them. A personal loan should improve your financial position, simplify repayment, reduce interest costs, or create a meaningful benefit. It should not simply postpone a larger financial issue. Before considering any loan, the first step is creating a complete picture of your current debt situation. Without accurate numbers, every borrowing decision becomes guesswork. Financial success begins with understanding exactly where you stand today before making commitments that affect tomorrow. The second step is calculating your debt-to-income ratio, commonly called your DTI. This is one of the most important numbers lenders evaluate during the loan approval process. Your debt-to-income ratio measures how much of your monthly gross income is already committed to debt payments. To calculate it, divide your total monthly debt payments by your gross monthly income and multiply by 100. For example, if your monthly debt payments total $2,000 and your gross monthly income is $6,000, your debt-to-income ratio would be approximately 33%. Another important lesson is understanding what these percentages mean. Lower debt-to-income ratios generally indicate stronger financial flexibility. Higher ratios suggest increasing financial pressure. Many lenders prefer debt-to-income ratios below 40%, although requirements vary. Another major principle is recognizing that approval does not automatically mean affordability. Some borrowers qualify for loans that place significant strain on their budgets. Lenders evaluate risk differently, and individuals should evaluate long-term financial health. Another important lesson is that your personal comfort level matters. A loan that fits lender guidelines may still create unnecessary stress if cash flow is already tight. Another major issue is ignoring future uncertainty. Income can change. Unexpected expenses occur. Emergencies happen. A healthy financial plan includes room for flexibility. The goal is not maximizing borrowing capacity. The goal is maintaining financial stability after borrowing. Understanding your debt-to-income ratio provides an objective measurement of your financial position and helps determine whether additional debt improves or weakens your overall financial health. The third step is evaluating the purpose of the personal loan. Not all debt is created equally. Some loans improve financial outcomes. Others simply move financial problems into the future. Another important lesson is understanding the difference between productive debt and reactive debt. Productive debt typically creates value, improves financial flexibility, or reduces costs. Examples may include debt consolidation at a lower interest rate or funding an opportunity that increases income potential. Reactive debt often covers ongoing overspending, recurring shortages, or lifestyle expenses that do not improve long-term financial health. Another major principle is calculating the total cost of the loan. Many borrowers focus only on the monthly payment while ignoring the total interest paid over the life of the loan. A lower monthly payment may feel attractive, but extending repayment periods often increases total borrowing costs significantly. Another important lesson is understanding opportunity cost. Every future loan payment represents money unavailable for saving, investing, or building emergency reserves. Before borrowing, ask whether the loan creates a benefit that outweighs the future financial commitment. Another major issue is using debt to maintain unsustainable spending habits. Personal loans should support financial progress rather than mask underlying cash flow problems. The purpose of the loan often determines whether it becomes a helpful financial tool or a long-term burden. The fourth step is stress testing your budget. Most borrowers calculate affordability based on ideal conditions. Wealthy individuals and financially disciplined borrowers often evaluate worst-case scenarios instead. Another important lesson is asking difficult questions before signing loan documents. What happens if overtime disappears? What happens if an unexpected medical expense occurs? What happens if insurance premiums increase or household expenses rise? Another major principle is maintaining financial margin. Margin is the difference between income and obligations. The larger your margin, the more flexibility you have when unexpected situations occur. Another important lesson is that financial stress often comes from lack of flexibility rather than lack of income. A household earning a strong income can still experience significant stress if every dollar is already assigned. Another major issue is assuming current conditions will remain unchanged for years. Personal loans frequently last several years. During that period, expenses, employment situations, and financial priorities can change dramatically. Before borrowing, evaluate whether the payment remains manageable under less favorable circumstances. The goal is not proving that you can make the payment today. The goal is ensuring the payment remains manageable throughout the life of the loan. Financial stability requires preparing for uncertainty rather than assuming everything will proceed perfectly. The truth is that calculating your debt before applying for a personal loan may be the most important financial step you take during the entire borrowing process. Start by identifying every monthly debt payment. Calculate your debt-to-income ratio. Evaluate the purpose of the loan. Calculate the total borrowing cost. Stress test your budget against realistic future scenarios. Another important lesson is understanding that borrowing should improve your financial position, not weaken it. A personal loan can be an effective tool when used strategically. It can reduce interest costs, simplify payments, and improve cash flow. However, it can also create additional financial pressure if the numbers are not carefully evaluated first. Another major principle is making decisions based on facts rather than emotions. Financial stress often leads people to seek quick solutions. Successful borrowers slow down, analyze the numbers, and make decisions based on long-term outcomes. Another critical lesson is that lenders determine whether you qualify. You determine whether the loan makes sense. Those are two very different questions. Before signing any loan agreement, make sure the debt supports your future goals instead of limiting them. If you found this helpful, hit the like button, subscribe to the Daily Yield, and leave a comment below telling us whether you've ever used a personal loan to improve your finances. Because we're building real financial progress, one step at a time.